All right, good afternoon, everyone. Good evening, everyone. Welcome to Financial Literacy 101. I'm Ross World. Today, we're gonna talk about index funds. Okay, index funds. This is one of the truest ways that I believe that a novice or anyone, it doesn't matter if you're a beginning investor or you are an expert investor. I believe that everyone should be investing into index funds. Now, some of you may get confused with the terminologies that index funds fall under a mutual fund. And essentially they do the way they're actually built and constructed. But we have to understand that a true mutual fund operates actively managed, and index funds are not actively managed like my ETFs that I always talk about. Actively managed accounts get traded almost either daily, monthly, or quarterly. And what happens is you have an actual broker you have a fund of stocks, okay? You have a fund of stocks which make up a mutual fund. And your broker, he's trying to beat the market. And everyone knows, even Warren Buffett, even your Jack Bogles, Ray DeLalos, those huge people in the investment world, they know it's impossible to beat the market each and every day. The market will win. And what I mean is they try to construct, they have all these stocks in this fund. So my hand is the fund and stocks are within it. So what they do is they actively manage your account, meaning that, okay, this stock is not performing well. Let me change this stock out. This stock is not performing well. Let me exchange it with this stock, and they replace it. Every time they make a transaction of putting in a stock, taking out a stock, they're creating taxes. And there's really no tax loss harvesting within that, meaning it's not going to save you any money in taxes. That means at the end of the year, when you receive that 1099 DIV because of your dividends, the money of accrual, and your interest, you can get charged for that, for making money. But what index funds do, they pick solid stocks and they hold them. So they don't really do a lot of exchanging back and forth. And with index stocks and the ones that I'm actually going to be talking about, two main ones, okay? I want you to focus on these two main ones because I don't care if you are a beginner. I don't care if you're an expert. This is where your money should be going. And to cut out all the other index funds, all the other mutual funds, all the other ETFs, these are the two that you should be investing in. Now, first, before I get into that, I'm going over to Investopedia.com. That's Investopedia.com. And I'm going to read their definition of what an index fund is. An index fund is a type of mutual fund with a portfolio constructed to match or track the components of a financial market index. So basically that's saying an index is constructed however whoever makes it, whether it be Charles Schwab, Fidelity, or Vanguard, they're creating it to either track or match the market index, which could be the Dow, the S&P, etc. Now, as I was saying before, mutual funds are more created to outperform the market, which they never do. You actually can lose money in mutual funds. A lot of people don't know that. But the reason why your broker will always tell you, hey, put your money in this mutual fund, is because he's getting broker fees. See, there is a lot of fees hidden in mutual funds. Because they're actively managed, whether it be taxes, commission prices, and also all sort of hidden fees. Now, if you read the book Unshakable by Tony Robbins, you will understand those fees. Now, I'm not going to go over those fees, but believe me, they are extensive. Okay, we're talking about anywhere from 1% to 5%. Now, let me read on. An index mutual fund is said to provide broad market exposure, low operating expenses, and low portfolio turnover. These funds follow their benchmark index no matter the state of the market. Low fees, guys. That's where we want to get into. Any fund that is charging you, I would say anywhere from 0.5% or above, is robbing you blind. It's robbing you blind. I have my notes here in a little blue, pink sticky note, but I'm going to get into some stocks here, some index funds rather, that contain stocks. And we're going to jump right into this. So number one that you have in your portfolio, the number one index fund you should have in your portfolio is the total market index. Now you say, well, where do I buy the total market index? You can either buy from Charles Schwab, Vanguard, and Fidelity. Now, key, they make their own total market index. And what they're saying is, and I'm going to read the definition for this one as well, so you understand exactly what I'm talking about. A total market index fund is a mutual fund or ETF, exchange traded fund, that tracks an equity index such as the Russell 300 index, the S&P 500, or the Wilshire 500, or the ones I'm going to go over like Charles Schwab and Vanguard and Fidelity. By investing in these stocks linked to a given index, a total market fund performance aims to match, right, that of the index in question. The underlying stock that these types of funds invest in are often highly diverse. Highly diverse. We're talking about diversification, not putting all your eggs in one basket, diversifying it, okay? And may include both large cap stocks issued by well-known corporations as well as small cap stocks issued by lesser known companies. So you essentially, when you're doing a total market index, you're actually investing in almost every company on the stock market. So you're matching it, it's tracking it. You're either tracking it or matching it, and the index are getting the funds. Now, I'm gonna give you the actual percentages and I'm gonna give you the tickers. So you can go either through Charles Schwab or Vanguard or Fidelity, which they have no commission price on these. My little research I did the other day, they do not have any commission price, so it's not gonna even charge you. And with the Charles Schwab and Fidelity, you only need $1 to start investing in these. Now, they do have an entry price. Some say, oh, well, you have to invest at least $100, your first initial deposit, and then you can do $1, right? So you can do a monthly payment of investing. And that's what you should be doing. You should be investing every month, at least a certain amount. All right, now they have these four up here and have all these definitions. I'm just going to give you the four I have because they have Vanguard, they have Charles Schwab, and they tell you what they do. They tell you the expense ratios and the percent, the Russell 3000, etc. So without further ado, Charles Schwab, the ticker is SWTSX. Okay, Charles Schwab, the ticker for the total market index is SWTSX, and that's Sierra Whiskey Tango Sierra X-Ray. Now, year to date, the performance of this total market index year to date is 22.58%. 22.58%. Now, if anybody ever heard my videos, I always say that 7% is great. You should never be inside of a stock or fund that's performing at less than 7%. These are performing more than 4 times, well, less than about 3 times 0.5. Okay, at 22.58%. 22.58%. If you don't know anything if you don't know nothing about math, just understand that the money that you put inside of this fund, year to date, since inception, okay, because we need to understand this too. Jack Bogle, before his passing, he was the CEO and founder of Vanguard, a $3.4 trillion company that he actually created back in 1975, index funds. And guess who hated it? The financial world hated it because it was low expense ratio. It cut out the brokers. Okay, it cut out the people who actually actively manage mutual funds. It cut them out. So they're not getting paid. Where Vanguard and all these other financial entities like, Charles Schwab and Fidelity, they're just getting a low expense ratio, and these are less than 1%. For this low expense ratio, the amount that you be paying for this, and this is just asinine, 0.030. It's pennies. It's pennies for them to return to you, the investor, 22.58% year to date. Year to date. Now, if you look at some charts, funds like these crashed during the recession, right? 2008, 2009. But now they're even higher than they were before. If you don't know anything about the stock market, just know this. Every recession or depression, stocks crash. Don't sell your stocks. Don't get rid of your funds. The stock market always comes back and break new records. Without further ado, Vanguard, their ticker is VFAIX. That's VFAIX. VAIX. That's Victor, Foxtrot, Alpha, India, X-ray. And their year-to-date percentage is 22.49%. That's 22.49%. And the expense ratio is 0.10. Okay, 0.10. Very, very low expense ratio. And Fidelity, their ticker is FSKAX. That's FSKAX. Foxtrot, Sierra, Kilo, Alpha, X-ray. And their YTD, their percentage to date, is 22.61%. That's 22.61%. And their expense ratio, and this is the think of the expense ratio as the operating cost, because you are investing through a financial institution who actually built this index fund for you, all right, for you to invest into the whole market. Because who has enough money to invest in the whole market? I mean, other than Jeff Bezos, he probably can buy one of everything. But other than him, you are investing in the total market index. Okay, and this operating cost is 0.015%. That's 0.015%. So if you say, okay, Ross World, out of those three, which one should I go with? I'm going to tell you why. I personally will go with this one, even though I love Vanguard and I'm invested with them. I will go with Fidelity, and I'm going to tell you why. They're higher than all the other two at 22.61%. And their expense ratio is much, much lower. But we're talking about pennies, increments of pennies, crushed down. 0.015%. Okay. The next would be Charles Schwab, right? And this is the thing. If you don't want to open up another account and you have a Charles Schwab, then Charles Schwab is 22.58%. It's only 0.2 less than Fidelity. And then their operating cost, their expense ratio, is 0.03%. Very, very cheap, guys. Very, very cheap. Let me look at your comments. I see people commenting in. All right. Diversification at its best by Esto Jackson. Jock Bogle is the originator. Indeed. Vanguard guru. See NASDAQ, Dow, Russell 200, etc. Okay. What's going on, Sheila? How you doing? And Miss Curly Girl, how you doing? Thanks for moderating today. And what else do we got? Fidelity, yep, at 22.61%. Thanks for putting that out. All right, let's move right along. Now we're going to move to the S&P 500 index. The S&P 500 index. Now let's just read, and this information is coming from Investopedia for my definitions, so I don't stumble over my words. All right, the S&P, if you don't know what the S&P is, it's the Standard & Poor's 500 index. Is an index of 500 of the largest U.S. companies listed on the New York Stock Exchange or NASDAQ. Selected by the Standard & Poor's Index Committee based on market capitalization, the S&P 500 index is a widely recognized barometer of U.S. equity market. S&P 500 index funds allow investors to establish a core allocation in large cap U.S. equities, which have been advised by one of the most iconic American investors, Warren Buffett, also known as the Oracle of Omaha. S&P 500 index funds seek to replicate the performance of the benchmark index by investing in S&P 500 with similar weights. These funds employ a passive or indexing investment strategy and invest all or substantial amount of their total net assets. Now, what that's basically saying in a nutshell is that this fund is investing in the top U.S. 500 companies. And it's a passively managed, not actively managed, not like mutual funds that's going to cost you more money in those hidden fees. Passively managed, which you're going to pay very, very low expense ratios. Okay. So now I'm going to give you the information for those three entities. Now, granted, you can go with and create a Charles Schwab or a Vanguard or Fidelity account. And as far as my knowledge is, as far as I can recall, is that there's no commission price. You're just going to pay those expense ratios, which are, again, pennies on a dollar. Pennies on pennies of a dollar. Okay, that's how small it is. But you can still go to Robinhood, which is commission free. So if you have a Robinhood account, right, you can go in and buy that absolutely free as well with no commission price. But some of you say, well, what about Stash? Well, don't forget you still have that $1 a month fee. If that's not a lot of money for you, then go ahead. But you can actually go through their own platforms where they're going to charge you and manage it totally, for the low expense ratio. All right. For Charles Schwab, the ticker, and this is for the S&P 500, investing in the top 500 U.S. companies that's listed on the New York Stock Exchange and the NASDAQ. For Charles Schwab, their ticker is SWPPX. That's SWPPX. That's Sierra Whiskey, Papa X-Ray. Their YTD, their year-to-date, their percentage that they have been accumulating is 23.13%. That's 23.13%. And their expense ratio is 0.020. That's 0.020. Now for Vanguard, their ticker is VFIAX. That's VFIAX. That's Victor, Foxtrot, India, Alpha, X-Ray. And the YTD is 23.14. That's 23.14. And the expense ratio is 0.040. That's 0.040. And Fidelity, FXAIX. That's FXAIX. And Foxtrot, X-Ray, Alpha, India, X-Ray. And their YTD is 23.17. That's 23.17. And their expense ratio is 0.015. That's 0.015. Very, 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 very low. And you say, okay, well, for this one, what is my recommendation? Again, Fidelity, right? But we're talking 0.1, 0.2. Do I think it's worth it creating another account to invest in the most market? Because here's the thing. This year could be Fidelity. Next year could be Charles Schwab. Next year could be Vanguard. So that's why I say if you already have these accounts in place, then I don't really think it's worth creating it unless you're just going to put your money, because they may track it differently, but they're still tracking it. I understand. So based on the numbers, the current numbers that I wrote down, I would say Fidelity again. Is beating Vanguard by 0.3%. Okay, 0.03%, which is pennies on the dollars. But here's it. The expense ratio is 0.015. That's beating both Charles Schwab and Vanguard. So you're going to be paying less to actually have this fund, which again, these are still pennies on pennies on pennies on dollars, regardless of which platform you actually go with. Okay? Regardless of what platform you actually go with. WGI Vision says, I can tell that you are starting to advance. Well, thank you. I hope I'm advancing. Okay. Esto Jackson, 500 large cap stocks, buy and hold. Definitely. Good advice, Esto. With these right here, index funds are long-term investment. Some of you are looking for the quick get-rich stocks, and this is not it. I'm going to tell you, if you want to get rich quick, if you want to lose your money quick, buy biopharmaceutical stocks. Biopharmaceutical stocks, because when they create new pharmaceutical drugs that, I don't know, I'm making this up as I go, guys. It cures eczema, right? And if you take it, you no longer have eczema for a month or something weird like that. The stock is going to balloon up. It's going to shoot up. Pew! And depending on how much money you put inside those stocks or how many shares you have of that stock, you will make a lot of money. But like any other biopharmaceutical, you have to get out once it reaches peak. And you got to have some sort of skin in the game, some sort of foreknowledge about, you know what, this is peaking. I saw this biopharmaceutical stock sell. And the reason for that, because a lot of pharmaceutical stocks, they go all the way up, then they come crashing down, and then they level off, right? Because of the side effects. You know that stuff, they give you all those commercials on TV about this drug, that drug, this drug. and all the great things it does. And then when they said the side effects, it speeds through. Oh, it might cause bleeding from the nose and diarrhea, right? It tells you all those particular things. So those are the two things that I want to focus on. And I wanted to give you another bit of knowledge before I get off here. I didn't want to stay on here too long. I wanted to give you the index information because I believe that index are the way that you guys should go. And here's the thing. These accounts have auto monthly transfer that you can continue to put $100 in a month, $50 a month, so on and so forth. But I wanted to show you this video, okay? I wanted to show you this video. It's about 10 minutes. You need to watch it because this is going to help you frame your mind. I watched it today, but hopefully let me know if you guys can hear the sound, okay? I'm going to move it over here. Let's do this. Let me know if you guys can hear it.
You should say, don't tell them that, Bob.
Yes. Don't tell people what you know. People do. My father was the head of education, PhD, all that stuff. I go home and ask him, so why don't we learn about money in school? And he looked at me and said, because the government doesn't let us teach that subject. The government tells us what we can teach and what we can't teach. And I thought that was strange. And I said, but aren't we going to school to learn about money? He says, no, your job is to get a job. I said, but you get a job to earn money. He goes, no, you're supposed to just get a job. I went, no. Isn't the purpose of a job to earn money? He goes, you're correct. I said, so why don't I just learn about money? I can skip the job part, you know? And he got flustered and he said, well, I'll learn about money. Why don't you ask your best friend's father about money? And I said, why? That's Mike. So I asked him. He said, because Mike's father is an entrepreneur. And I said, what are you? He said, I'm an employee. I'm a government employee. I went, oh, what's the difference? This is the difference is an entrepreneur must know about money. Well, then they're no longer entrepreneurs. And he says an employee doesn't have to know anything about money. Because the government will take care of the company will take care of it. So I'm all confused. But I took my dad's advice and I trundled over to Mike's father's office and knocked on his door and I said, hey, I'm here, 9 years old. Teach me about money. He says, beat it, kid, you know. But that's where the story of Rich Dad Poor Dad started. And finally, through persistence, my rich dad started teaching me about money on one condition. And that condition was he would never pay me. He says, the moment I pay you, you think like an employee. He says, that's the trap. Entrepreneurs work for free. And now I'm 9 years old, my head's going cracking in half. He says, you never want a paycheck. Understand that, kid? Okay, I got it. And he says, well, how do I make money? He says, that's what entrepreneurs figure out. It's like, so how do I learn about money? So he would just break out a Monopoly game board. So I would work for free and pick up cigarette butts and get hotels and restaurants, and I would clean and do menial tasks. And as I got older, I started getting into office work and marketing and accounting. And I was an apprentice basically, but I always worked for free. And he would teach me about money. But the way he taught me about money was playing Monopoly. And that's finally one day I got upset. I said, well, when are you going to teach me about money? He says, what do you think we're doing? We're playing Monopoly. He goes, no. What do you think we're doing?
All right. So a lot of you know, I saw you guys in the chat. That is from Rich Dad Poor Dad. A great 10-minute video. I showed you a little bit. I didn't want to bore you. In the name of that video, let me just look at it really quickly, guys, so you can look it up. It's the speech that broke the internet. Keep them poor. Okay. I'm stumbling on my words. Here I go. The speech that broke the internet, keep them poor. Okay. So I want you to go out and look at that 10-minute video, and it should change your mind. So this is Financial Literacy 101. I wasn't before you long. Hopefully you learned something. I hope you guys like and subscribe. And also share this video. Share this video so people get the information about these index funds and these 3 entities that you can invest in. All right, I'm just going to read your notes. He has some great books on finance. Yes, he does. Also, one about getting out of debt. I read that one as well. Okay, listen to an audio book. That's pretty good. And thank you, Miss Curly Girl, for moderating today. And you guys have a great and blessed day. And by the way, it's my birthday, so that's why I'm not staying on long. I'm turning a whopping, man, when you get old, you forget. Anyway, y'all have a great day.